Welcome to preparing for your first professional fundraising round. If you haven't noticed, we've been doing a lot of kind of kicking things off programming in the Gust ecosystem to kick off the new year. And this is kind of I'm going to say a super presentation that combines a lot of our expertise, our product philosophies, and the nature of where Gust really sits in trying to help founders in the ecosystem. And Pete has put together a presentation to really walk you through all the things you need to consider before you go out and raise your first professional round. And by professional round, we mean from angel investors. Sophisticated investors who invest in startups are familiar with that. I'm pretty excited for the format of this one. If you've been to ones in the past, we've sometimes sniper targeted very particular subjects, but this one's going to enter in from the point of I need to raise money, to get this venture off the ground. What do I need to consider? And then move into once you really understand what that means, all the things that you need to get your ducks in the row so that you have the maximum chances of success. So, as always, we're recording this. We'll save some time for Q&A in the end, although this is a dense presentation. So we will probably only have maybe 10 minutes or so. We'll see how fast Pete can talk and I could interrupt. But we will send out the recording afterwards with follow-up materials and anything that comes up in the presentation. And this is a mega packed week. On Thursday, we have a follow-on event with our partners in HubSpot, which is just an open Q&A. HubSpot's going to lead it, but it's going to pepper Pete and I with questions, and we'll have audience participation as well. So keep those questions coming. Use the chat, use the Q&A functionality. We can probably even export a list to fuel that event on Thursday. So let her rip. Without further ado, Pete, take us away.
Awesome. Let me get my screen sharing going and we will go ahead and get started. So real quick, intro-wise, I think about a month ago now, we did a presentation about a tactical guide to pre-seed fundraising. I'm going to kind of speed run that content at the beginning of this presentation just to reset some context. If you weren't around for that one, it is published on YouTube and we'll send out a link to it in follow-up if you feel like I went through the context too quick. But we're going to get through that and then really start talking about, okay, once that context and once that foundation is set, what kind of come next. So as Nash said, today we're going to talk about preparing for your first outside round. Generally, that is going to be your first pre-seed round or seed round. And usually you're going to be approaching some angel investors, organized angels, or micro VCs for that round. And this is typically a pretty tough round. And mostly it's because expectations are changing. Instead of raising from friends and family, you are now actually approaching people who do this semi-professionally for a living. There's more money at stake, and there's more of an economic focus than just supporting the people that you know and love. Which means it's important to align expectations, which means you need to be aware of angel economics, which are based on the fact that 90% of angel portfolio companies fail to return the type of returns that make angel portfolios, which means that each company they invest in has to potentially be capable of returning 30 to 40x on their investment. So baseline context here today is that you are building a big company and you are expecting a $240 million plus exit on top of a $40 million top line revenue benchmark, right? And in order to convince angel investors of that, your job is to tell a really compelling science fiction story towards that end, which is made up of the things that they care about: big growing market, great team, capable, trustworthy leader, compelling plan, roots in reality, and actual traction in the market. Looking at that compelling plan, you understand how much you need to raise and what you're actually going to do with that money in terms of business outcomes. And you have a compelling plan of how you're actually going to approach executing against those business outcomes. All right, so this is just coming from the perspective of you have all of this in place. You're building a big business, you have traction, you have a great team, even if it's early traction. The next step is, okay, as you approach investors, there's a whole bunch of easy no's that can come up because this is the first time you're doing this, or you're lacking some context around common terminology, what early stage investors are looking for in terms of company diligence, and how the process works. And I think the biggest foundational thing here is to get an understanding of the process. There are some great books out there. David S. Rose's Angel Investing, Venture Deals by Brad Feld. David will be releasing a new version of angel investing here in probably the next quarter. Reading those books is great, but today we'll give you a quick overview. So first, understand the basics of the process because knowledge actually gives you leverage. If you can speak in the terms that investors understand and you're not confusing terminology and you don't have weird expectations, that will all help you avoid kind of an easy no of this person doesn't know what they're talking about and this person doesn't understand the startup trajectory. So we're not even going to waste time evaluating this company. And the first thing we'll go into is funding instruments. We see this a lot. Early investors don't buy equity. Sometimes new founders will come to us trying to sell common equity to friends and family, or not understand what the instruments actually look like. But by and large, in the early stages, professional or semi-professional investors invest in what are called convertible instruments. And these are instruments that take an investment now for a promise of future equity. You very likely have heard of the SAFE or a convertible note. Those are the predominant instruments until you get to a seed stage financing or beyond. And generally, any round that starts with the term series involves actually selling stock to investors, and no round prior to that does. So again, convertible instruments are generally cheaper to negotiate. There are less bells and whistles. They exchange capital now for equity in the future, and they encode some investor rewards and protections for investing in you early. And they convert when you actually sell shares in one of those series rounds in the future. Good to also note, you are selling securities even when you are selling convertible instruments. So you should have a broad understanding of what that actually means. And generally, the two biggest things are you can't generally solicit your raise in most cases unless you're going through a crowdfunding platform or leveraging an exemption that allows you to do so. And by and large, startups on a venture or venture optional growth trajectory will usually raise from accredited investors. Those are people who make more than $200,000 a year or have a net worth over $1 million, excluding their primary residence. These are people that the SEC have deemed are financially secure enough to invest in very, very risky bets without putting too much onus on those startups to actually give them a ton of information, which at this stage doesn't really exist. So if you are on Twitter telling people you are raising money, or you are raising from family members or friends who don't meet those thresholds, you are likely engaging with a set of folks that are going to make it more difficult for professional investors or semi-professional investors to say yes to your company down the line. And the primary kind of investor sweetener or protection mechanism when you're using a convertible security is called a valuation cap. An evaluation cap isn't exactly a valuation of your company, but it does kind of stipulate, based on the investment terms, how much of the company the investors will own right before the conversion event happens. And again, that conversion event will be a future financing, likely with series in front of it, like Series Seed, Series A, Series B. And the important note is that lots of founders overcomplicate early stage valuation caps. They are largely based on market norms, data that is published by Carta or the Angel Capital Association. There isn't typically a lot of information available about the company in terms of hard revenue or compliance or things like that to base a more serious financially backed valuation on. So largely, these are driven by a few things. The first is an understanding which comes from you of the amount of capital you need to actually accomplish something amazing. And again, more data available now than ever before, but you can consult how much money founders typically actually utilize or burn to accomplish a certain stage. The next factor is how much of your company you are willing to sell to take advantage of the opportunity to do that amazing thing. And again, data here from the market will let you know how this typically nets out between founders and investors as the company progresses. Generally speaking, anytime you raise equity investment in a round of funding, you are going to sell somewhere between 10 and 20% of the company. But if you have excellent traction, tons of investors want to give you money, you may be able to get a little bit lower or negotiate towards the lower end of that spectrum. If you have less traction and need money more, you will end up likely selling more of your company. But if you take the amount of money you need to accomplish something amazing and divide it by the percentage ownership you're going to sell, you will get your rough valuation cap or valuation. And again, what you're looking for here is the output of this function, whatever your valuation cap or valuation looks like, you should make sure that that is roughly in a normal range for the stage of company you are, right? So pre-seed companies are not typically going to command a 10 million valuation, right? So if that's the output of this function, then you've got to go back and readjust your expectations for market norms, or have a really, really strong story. So again, valuation caps, largely based on market norms. It's an investor protection. It can come in two flavors, pre-money or post-money. Predominantly, the convertible instruments out on the market today that have been standardized utilize post-money valuation caps. You get an understanding of what that means. It doesn't necessarily make them better or worse, but you as a founder should understand how they impact your dilution as you take on more funding. And importantly, this is not really a point in time valuation of the stock of your company. It is early stage. It is investor protection. It's based on market norms. Yes, you do have to exceed it for everybody to be happy, but it is not actually saying this is how much your company is worth. And in particular, it is not saying how much your common stock is worth, and it has nothing to do with a 409A valuation. And very often we'll see founders confuse these terms or these different types of valuations and get themselves in a tailspin about trying to tie their valuation cap back to some early stage financial metrics, which are largely a fiction, or trying to use a 409A valuation to justify an investor facing valuation and get themselves into trouble with investors because it doesn't make any sense. So a valuation cap is a very specific thing, not the valuation of your common stock, not a 409A valuation. Okay, next up, you understand all of this. You've made a good presentation. You understand that the composition of your round and what you're looking for to do something amazing and how much you're willing to sell is roughly in line with market norms. And now we have to talk about, okay, how does that money actually come in? And the first thing you need is to actually have a corporate entity. And the corporate entity does a few things for you. It allows you to limit liability of participants. And at its core, it gives you the structure for a whole bunch of people to work together on a shared enterprise, right? So it removes this enterprise from any individual and tries to create a vehicle that allows a whole bunch of people to do something big together. And in order to do that, you probably need a C Corp. Sorry, this is my least favorite slide because it's blurry, and I know probably all of you are trying to read it. We will send a better version in the follow-up. But essentially, going through this, if you are attempting to be a large company, which means you're going to exit through M&A or IPO, or you're going to target a multi-million dollar top line revenue number, and you're going to want to incentivize employees with equity as you go, you're going to need a team to do this thing, and you're going to take on equity investment from outside investors. Generally, all arrows point to a C corporation.
While you're there, real quick, because it's
Yep,
a quick question. S corps. Do you get
we
the
will
same
get to
result
them.
in S corp? Oh, okay, you got it. Never
So
mind.
S Corp is not actually a different type of corporation. It is a tax election you can take on top of a C Corp to be taxed as a pass-through entity. What you'll notice maybe on this graph, if you're really good at reading and have better eyes than most, is that S Corps limit you in a couple important ways. One, you can only have one class of stock, which means you can't establish a preferred share class to sell to investors later, which is pretty big no-no. It also limits the number of people who can be on your cap table and limits those people to natural persons and US residents, if I'm remembering correctly. But we'll send this to you in the future. And the last bit is, and we'll talk about this later, it does disqualify the company's shares for qualification under qualified small business shares, which eliminates a huge capital gains tax exemption for early investors, founders, and early team members who are relying on equity to be the payout for their long-term bet on the company. All right. So Delaware C corporations, despite Elon Musk's ramblings, are still probably the ideal structure to organize a large number of people in pursuing a big, risky bet in the United States. Often we get the question from founders, even repeat founders, why Delaware? And the reason is that Delaware has amassed a huge body of case law that gives investors and people you're contracting with, and even your team members, confidence in how the law will be applied. Other states have adopted corporate codes that are almost identical to Delaware. However, nobody has the body of case law that gives people as much confidence in the application as Delaware does. So Delaware has a huge history of litigation in the chancery courts. Everybody's super confident, even if they don't always like the outcomes. Now, oftentimes, we will also see that people are not a Delaware corporation as they approach their first professional round. This is okay. The longer you've gone and the more you've accumulated, the more complicated it gets and the more expensive it can be. But sometimes early stage founders do not have the money or the time or the expertise or the network to navigate this conversion prior to approaching investors. So, from your point of view, as somebody approaching pre-seed funding, if you're not a Delaware C Corp and you are approaching angel investors and wanting to go on a venture or venture tangential growth optional path, you need to at least have a story and hopefully have a plan, right? So you want to know about this ahead of time. You want to let people know why you did what you did, why you're an LLC, and if you do plan to convert, be able to articulate a coherent plan. We are going to do statutory conversion. We are going to wind this down and spin this up once we are sure of commitment above X number of level, or we're not going to do it. And if you want in, you have to invest in an LLC and get over it. But important note, a lot of the convertible instruments that we talked about prior are specifically tailored to invest in Delaware corporations. The YC Safe even says it within the document that the company is saying that, yes, it is organized as a Delaware corporation, as a rep and warranty, very light in the investment docs. So typically the expectation is that if you're using a safe or convertible note, you are a Delaware C Corp, or your investors are closing their eyes and hoping that it will happen in the future. If those are your investors, also recognize that you may be working with some unsophisticated investors that may cause some trouble down the line. The next bit that we see a ton of confusion about is incorporation isn't actually enough. In order to limit your liability, you need to actually establish the full governance of your corporation because corporations are designed to allow a ton of people to contribute to a shared enterprise. They have a more strict outline of how the company runs. So in order to actually establish the corporate veil, which limits everybody's liability, you have to establish a board of directors, you have to elect officers, and the company has to have shareholders. And generally, if you're going to do those things, you also want the company to have a set of bylaws that sit on top of Delaware corporate code and give a little bit more detail about how the company is going to run, whether or not it's going to keep digital or physical records, whether people have to meet in person or they can sign off on things online via written consent, when they're going to meet, how they're going to meet, who has to have input and visibility into what and when. So generally, in order to fully establish governance and limit your liability, you have to accomplish all of these things. And especially in order to actually issue equity, you have to have a board of directors. So the board signs off on each equity grant. And an equity grant is typically for early founders and team members, a grant of restricted common stock that gives them direct ownership in your company. This is how you establish shareholders, which is that final level of governance in the company. One thing to note at a high level, ownership is your company's greatest asset. It gives people a stake in the ultimate financial outcome. It is what they are trading near-term salary for, a larger financial gain. Their ownership of equity is what cements it. All right, so you really, really want to be sure that you align ownership with the input and the output of your early team members. All right, nobody should be on the cap table with a percentage that you cannot explain how they are delivering against that percentage in the outcomes and business progress of the company. As you do that, especially for founders, it is important to have a conversation about how you're going to come up with that number. There is a school of thought that says, don't worry about it, split evenly between co-founders and get to the races. Generally, I think that works well if the co-founders have worked before, worked together before, done a startup before, are best buds, really have already gone through all of the relationship milestones that will allow them to navigate conflict easily. If that's not you or you're not sure, go through and have the conversation about what people are going to contribute in terms of time and capital, what their expected output is along technical lines, business development, etc. Get on a firm footing with your co-founders about what everybody is putting in, how much time they're spending, and what you are expecting to see out the other side. And that will reduce a whole ton of conflict in early co-founder relationships. It will also potentially give you a starting point for your co-founder equity split. And we believe in this philosophy so much that we built a tool around it. You can find it at cofounders.cust.com. It's free, it's collaborative. It will ask both you and your founders to assess each other's skills, and it will pop out a starting point for this conversation. Now, getting it aligned at the beginning is super important, but it's also really important that you make sure that the incentives stay aligned. And one of the super important ways you do this is you put vesting on your early team member grants and your co-founder grants. Vesting essentially gives the company the opportunity to recoup the shares if the relationship doesn't work out. So if Ryan and I start a company together and we split 50-50 and neither of us vest, and Ryan decides 6 months in that it's not going to work out for him, or me as his co-founder decide that he's not pulling his weight, and Ryan leaves the company, he walks away with half the ownership, the company's biggest asset for retaining and incentivizing talent and future investors. Half the company is gone, right? It walks out the door and is no longer contributing to the future success of the company. We call this debt equity. Investing is your primary mechanism for avoiding debt equity and making sure if something doesn't work out, that your cap table still reflects previous contributions as well as properly incentivizes people to be pushing the business forward on an ongoing basis. The next up is a couple of tax things to keep in mind. And one of the important things about keeping incentives aligned is making sure that one person's financial outcome does not drift too far from another's. The 83B election on a co-founder grant is something that all founders should consider. Essentially, what it does is allow you to fully recognize the income tax burden on your restricted stock grant in the year that you receive the grant. If you don't file this election, which you have to do within 30 days of the grant date, then by default, the IRS will see vesting on your grant and they will assess that you have a substantial risk of forfeiture because if you leave the company can automatically repurchase those shares back. So by default, the IRS will not recognize income events on those shares until they vest, and the company's opportunity to automatically recoup them falls away, which can mean for founders that 4 years in, when their vesting is finishing up, if the company has done its job and is on a spectacular growth trajectory, a founder may be paying income tax on a much, much higher share price on what is functionally an illiquid asset. Which, if I file my 83B and Ryan does not, or actually opposite, because I would probably be more likely to forget it, I would have a huge income tax burden in year 4 that I would be struggling to meet, likely still on a founder's salary and Nash would be just fine, sitting pretty. And now we have one co-founder who is way less incentivized to continue to pour the blood, sweat, and tears over the next 6 years um, to make this company a resounding success. And you have a whole bunch of blockers to potential future investment or the financial health of the company, because we're going to have to figure this out. So either the company is going to make a loan or there's going to have to be stock top-ups in some way, a whole bunch of complication that is unnecessary. So make sure to evaluate and follow your 83B elections, get it done within 30 days, require it. Smart investors will be looking for it. And the last, we touched on this before, is QSBS. And essentially, if your shares qualify as qualified small business stock and you are the original holder of those shares and you hold those shares for at least 5 years before you sell them, you get to save $10 million on capital gains. Or to be more clear, you don't have to pay capital gains tax on the first $10 million of capital gains, which is a huge tax advantage for founders, for early investors. So again, smart investors will be looking to see that this is preserved. Now, QSBS has been on the legislative chopping block a few times over the past few years. However, it is easy enough to stay on the right side of this, that it is worth your time to understand it and not do any of the things that easily disqualify you. The first would be taking the S Corp election for short-term income tax write-off purposes. You will likely disqualify your shares from qualifying under QSBS in Section 1202. The other is that the company should not repurchase a ton of shares from shareholders. This most often happens if the company feels like they messed up their initial stock grants. And even though everybody's staying with the company decides to go through some trickery and repurchase the shares and redistribute them. Notably, if somebody leaves because the relationship ends or substantially changes, that does not qualify as a redemption, and you can still maintain QSBS status. So if Brian Nash leaves and I invoke the automatic right to repurchase based on his vesting, we're in the clear. If Ryan Nash and I issued all of our shares and we find a third awesome co-founder and we want to give them shares, but we don't have any, and the way we decide to handle that is to sell a whole bunch of our shares back to the company and then have the company issue those shares to our new co-founder, then we may be in trouble. Similarly, if we decide, oh, the way we're going to fix this is we're each going to transfer some of our shares to our new co-founder, then our new co-founder isn't actually the original owner of those shares. And even though QSBS is still intact for the company as a whole, QSBS is not intact for our new co-founder, which means, again, 5 years down the line, when everybody is liquidating or thinking about liquidating, we have a huge capital gains tax advantage that our co-founder missed out on, which again can lead to misalignment in incentives. Next up is equity planning. Once you get this initial stuff right, once you take the basic steps to make sure that incentives stay aligned, when you start thinking about a pre-seed round, likely some of the capital that you bring in is going to be used to incentivize new hires. So a big question will be for you to answer first and communicate to investors who gets equity in this round. Who are the people who you're going to bring on? Are they contractors? Are they full-time employees? What is the equity that they would expect? How does it align with the market? And what is the total equity they're going to command? And the reason that you want to know this is twofold. One, your investors may insist, or you may decide based on the progress of the company that it's time to set up an equity incentive plan or an option pool. And if you take the time to understand your hiring plan, you can create an option pool that is relatively tightly bounded to your hiring needs rather than creating a standard option pool of 20 to 25%, which can increase founder dilution in the future. The second is that within the funding round, if you are raising via convertible instruments, there is no necessity that you're going to have to go back to the state of Delaware, amend your certificate of incorporation, and create a new share class of stock. However, if you don't have any equity left to actually incentivize your team members through this round, you are going to have to go back and do some corporate filings to potentially expand the number of common stock shares available and do some pre-planning and formational work to set up your equity incentive plan. None of those are showstoppers, but the big problem that can typically happen is that founders end up promising their team members shares, not actually being equipped to incentivize those people. And again, incentives get misaligned because team members miss out on a financial return, or the equity never actually gets issued, and the company takes on this weird, never-ending liability. Along with your equity grants, anybody who owns equity in the company and anybody who is working with the company needs to make sure that the intellectual property they're generating is actually owned by the company. So one thing professional investors are going to be looking for is that they are investing into the company and that the company controls all of the things that make it valuable or that will make it valuable in the future. So any work product, any code that's written, trademarks and patents need to be licensed and associated with the company. If you have a co-founder who exited, who might have a claim on shares but owns intellectual property and didn't assign it to the company, that can be a huge red flag. So you want to make sure that anybody who is producing work product for the company, whether they are a co-founder, whether they are a contractor, whether they are a W-2 employee, make sure that the agreements that you are using to paper those relationships stipulate that IP is owned by the company. Particularly with contractors in the US, if you're using US-based contractors, By default, work produced by a contractor is not owned by the company that commissioned it. They only get a perpetual license. So make sure that your agreements cover these things. If you're bringing on a founder and you haven't quite navigated whether they're going to be a contractor, a W-2 employee, or what have you, you can use what's called an IP assignment agreement or a co-founder IP assignment agreement that is basically a lightweight non-disclosure and IP assignment agreement that does not stipulate the specific terms of employment. And last but not least, you need a bank account. Investors will require a place to actually put this money. It can't go to your personal account, and commingling personal funds with business funds is a huge no-no that can get you in a ton of trouble down the line. Um, Also, establishing a bank account for the corporation, especially a modern one that will allow you to issue cards and run all your spend through the company, makes it way easier to establish good bookkeeping and accounting practices as you get that started over the course of the first couple years of the company, which might not be a huge issue for your pre-seed round because you're super early, but will absolutely be an issue as you approach later rounds. And I guess last, but maybe not least, is to hawk our own wares. So if you are navigating this process, we help. It's what we do. It's why we exist. And we do that through a few different offerings. First, regardless of whether or not you use our software, we run a program called Mission Control, which is designed to be an accelerator and support network for your startup. We think of it as CEO school, a fractional co-founder, a pre-seed accelerator. It includes expert support, workshops that actually help you navigate core strategic problems with your startup, weekly office hours. We help navigate back office challenges. We bring in insurance providers and tax accountants and legal experts and financial modeling experts to kind of educate and guide. Um, and you get a whole bunch of discounts on tools and services, including our software. And if you're specifically navigating corporation and want to check a whole bunch of the stuff we talked about off your to-do list, we offer Gus Launch, which is a full incorporation formation and equity management solution for companies to help you optimize early legal. Um, you will recognize a whole bunch of things we talked about on this list, but it's designed to support full coverage for early stage founders navigating early legal, cap management, legal templates. It's designed to be safe to do without a lawyer. And then we also keep a stable of early stage lawyers who work with startups to tag in when you actually have a strategic legal need. Because our motto is every startup needs a lawyer. You just probably don't need one for incorporation.
Or post formation or early standard contracts, you will want kind of a lawyer on your sidecar or on your, yeah, on your sidecar for those really specific to you questions. But you do not want a lawyer to charge you $600 an hour to educate you on how 83B elections work and whether they're something you want to do. Like you can get that through your own research, or you can come to us and we can really help explain all the consideration that you need to know. So I threw a link to Mission Control in the chat. I also had one for launch previously, but I'll throw another one in there. And I think it is notable. Sorry, I was answering chat, so Pete might have mentioned this, but if you are already incorporated, launch still might actually be able to work for you. This year, we're kind of rolling out some more functionality to help companies get more streamlined. A lot of people get set up through something like LegalZoom or Stripe Atlas or just a local law firm, and then they hit that first, conversation where somebody's like, "Oh, you're in Delaware, right?" Or, "Oh, you have, 10 million shares, right?" And they're like, "Oh no, I got 1,000 shares because I went with a lawyer, but I was in Delaware because I kind of heard I should have done that." We can actually help with that now. So we have an onboarding process. It might not meet everybody's needs, but we'll work with you to see where you're at and see if we can kind of like get you on the fast track so that you no longer have to bits and pieces, piecemeal do all your agreements. You'll have a digital cap table, every contract you need, and just be off into the races. Pete, I can't believe you got through that in 36 minutes. It's like a time dilation effect. Every time we put more into this presentation, it does not seem to change how long it takes to get through it. But that's a good thing because we're getting some good questions here that I can jump right into.
Cool, let's do it.
All right. I threw a little bit in the chat around this, but I thought getting your brain in a little bit of back and forth. Looking to hear our thoughts on solo founders with vesting schedules that are less than 4 years.
Well, again, it's up to you. Uh, Whatever you do, as long as you have a compelling story, um, it can be fine, right? These are norms because they make things easy. Startups are all about breaking convention. You just want to be smart about where you break convention, and making sure it aligns with your core business purpose. If you're a solo founder, you can do whatever you want. If you're a bootstrap solo founder, even more so. So you can set your vesting schedule to whatever makes sense. Where the question comes in is when you need a co-founder, or when you bring on an exceptional early team member who knows startups, or when you start having conversations with investors. All right, your co-founder may see that you have a vesting schedule that doesn't incentivize you over what they believe the lifetime of your contribution needs to be to make the company successful. Right. And as a co-founder looking at a startup, if the other founder is already vested, but the company really needs me to get from 0 to 1, then that's going to be a deal breaker for me if we don't get that sorted out. Because I would expect to vest over at least 4 years, maybe more. And very likely investors are going to see the same thing. So if you do need outside capital, it's going to be a conversation point. But if you have a good story and you're confident in it, and you're willing to defend your choice to future team members and investors, then go for it.
I want to put a slight caveat on the go for it. I will say a lot of the best practices are built because they compensate for almost any given situation. So, for example, if you're a solo co-founder, you don't plan to have a co-founder and you're not going to raise capital until you're so successful that you can determine all of the terms and you're going to play on your rules. If you set up a Delaware C Corp and grant yourself stock that's fully vested, nobody's going to say anything, right? You're the sole director, you're the sole owner of the company, things are fine. If later on things change and you need to get somebody involved, now your story changes and maybe you have to amend that. Maybe, an investor says, no, you have to have a vesting schedule, so you have to pay legal fees and whatnot. And you can change your story, right? You can change things. You're 100% in control of your company. You can make that decision later. However, if you're a solo founder, you start a new company with the same thing. You grant yourself your stock with a standard 4 year vesting schedule with a 12-year cliff. Nobody can do anything. You're 100% shareholder of the company. You're the sole director. That vesting schedule does not give you any less ownership of your company. Nobody can force you to do anything because of that. You literally own the shares. You have the full voting rights. The only thing the vesting schedule does is set up the company's right to repurchase them should you leave. As you're a solo founder, there is no company if you leave. So there's nothing that can actually execute that vesting schedule. So if in 2 years plans change and you go and communicate to these investors or these new team members of like, hey, I'm bringing on more people. I have the standard vesting schedule. I'm halfway through it. It's so much easier than having to explain the non-standard thing. And a lot of the things kind of fall into that place where it's like the standards are usually in place because it just makes less friction at any given point. So unless there's a really crazy reason that you're the expert on why you should be fully vested from day one, there's really no harm in just adopting the standards just in case you tend to fall more in line with how things tend to go. I suppose that's not contradictory to what you said, Pete, but I thought there's a little bit of nuance there. I think a lot of people think of vesting schedules as, oh, I don't own all my equity if I'm under vesting, and that's not true. You have your full voting rights. The only difference is if you choose to leave or the company kicks you out, they can repurchase them back in a very nice, clean tax way that makes it easier for the company to survive. But in the early days, when you're majority shareholder, that's rarely going to happen. You are the company.
And just to clarify, that is for direct common stock awards, restricted stock grants. Those terms all mean generally the same thing, which the vesting is typically reverse vesting. The company has a right to repurchase. Once you switch over to options, you are giving somebody the option to purchase stock, and their option to purchase accretes over time. So when those are canceled, they just don't have the option to buy more. So options vest slightly differently than restricted stock awards, common stock grants that are typically used for co-founders and other early contributors.
Perfect. Next up, we have Suresh. How do you determine the valuation cap for a pre-seed investment if it's not based on a 409A valuation?
Yeah. Go back to slide. There were a lot of them, sorry.
Yeah, there we are.
Okay. So generally at the early stage, right? And I guess we can start. A 409A valuation is a specific thing. It is a valuation to allow companies to establish safe harbor under Section 409A of the tax code, which only applies when you are issuing options to people, right? So the way it works is when you set up an equity incentive plan, you have to set a strike price for the options, which essentially establishes a fair market value for the underlying common stock. Since you are incentivizing employees with equity, more people are involved. The IRS takes a perspective on this, and they are looking to make sure you are not overinflating or underpricing your startup stock, right? Because it affects the tax base that gets paid into the IRS and taxation system at a future date. So, what you do to get safe harbor underneath Section 409A is you have somebody who is not involved with the company, which typically would be seen as called a 409A valuation provider, do an external valuation of the company, depending on what the company has, whether it's revenue, whether it's not revenue. They will use a set of methodologies to come up with a reasonable strike price slash fair market value for your common stock. Having a company do that is external to yours is enough to give you safe harbor, right? So that is what a 409A valuation is for. And it is notable that a 409A valuation against your common stock, the common stock share price is going to be significantly lower than the share price of shares that you sell to investors. So in your Series A, you will create a new share class called Series A Preferred and probably a couple other related ones. That price will be determined by the valuation you negotiate with investors. And because those shares of stock are convertible preferred shares that have additional rights and preferences for the investor, they can justifiably be priced higher than the common stock that goes to team members and co-founders, which typically pays out last, right? So when investors put in money, when a good thing happens or a bad thing happens, they get paid out first before the common stock. So the price of shares that you sell to investors typically floats significantly higher than the common stock shares. And then in an M&A or when you go public through an IPO, everything converges, everything turns into common stock. Everybody is momentarily on the same level, roughly speaking, with a whole lot of nuance alighted. Um, so that brings us back to how do you set the valuation if it's not a 409A? So first thing, based on that previous note, right? They're just fundamentally different. You're not trying to value shares of common stock for an equity award to an employee. You are trying to see how much an investor will value your company for, which prices in an expectation about the future growth of the company. In the early stage, there is not a lot of stuff out there to determine that. There are valuation checklists and other valuation methodologies, but realistically and broadly, valuations tend to follow the herd and follow market dynamics. Conceptually, it's a little bit of a weird, like chicken and an egg scenario, but it's been established for so long that these things fall into norms and there are expectations about how much ownership each type of investor is going to need for a company that is going to go through future funding rounds and hit an exit. So they largely have mandates about how much of the company they need to own. The company has some desire of how much money it needs to raise to do something awesome. And then you divide and you look at the outcome and you hope that it's in market norms. And if it's in market norms and everybody sees a good opportunity to pursue the something amazing and the wonderful financial outcome, then the deal gets done.
Awesome. I hope that answers your question, Suresh. Next up, and I believe she's adding context to this, is it a red flag if you give a family member 5% who isn't a part of the company? They don't even want voting rights. They just want to own stock. I
Um,
can take a stab at this if you want,
yeah.
break and you want to code through chat. I would say off the cuff, yeah, it's probably a red flag because, like what Pete was saying, is you want a narrative to support things. So if this is purely just a compensation thing, like this family member has supported you, you want them to share in the eventual success of this company, et cetera, but they're not actually contributing to the company and they're not part of the effort to make the venture successful, et cetera. It's far easier from a communication standpoint if that arrangement of compensation is outside of the ownership and the voting rights of the company. So sometimes founders will set up like a trust for their ownership or an LLC or something like that, where they are the sole voting member and the controller, and that's what investors are going to want to see is the founding team in the early days has the majority of control and they're the responsible party and they know who's going to vote, they know who's going to be participating in company governance. But if you want to say, hey, if things are really good, contractually 5% of the winnings, go to my uncle, you can deal with that on your personal, the personal side of your setup. What investors will look at the cap table and ownership levels is all the people that are on the cap table have contributed enough to the company to justify their ownership if they're fully vested, or are continuing in that capacity to make sense for whatever vesting schedule is set up for them in the future. Or caveat, if they gave a bunch of money, they're holding economic upside only thing, but that's because they exchanged it for value. So I'd say just divvying out small percentages to your friends and family who are not contributing to the company, probably a red flag. Not that you can't do that in material effect in the world, but just don't have it as a voting right. And the other thing is one stock is one vote. That is the most common thing. You authorize common stock with Delaware, every stock gets one vote. Small percentages can't really shift the tides for the first couple years. It's not until you have, a lot more shareholders that those kind of things get interesting. But trying to come up with non-voting stock classes, incentives classes, and things like that is often just not worth the legal headache to put that all into place. It's a lot easier just to do the standard stuff and wrap that up personally on the side. Last note, 5% is a huge equity grant in the early days. Most advisors, and when we say advisor, we mean somebody who has 2 to 3x the experience level that you do in your given industry or in an industry that's important to the company. They're a luminary of the field. Their name gets people to look at it on the slide deck and say, oh, wow, that person's advising this company. That's interesting. They get fractions of a percent, a quarter of a percent, a tenth of a percent, maybe half of a percent if they're really pretty big or the company's at the right stage. So to have 5% just 100% to somebody who is not huge in moving the company forward is probably going to be an additional red flag. It shows that the founder might not be seriously consider like who is incentivized to make this company grow and participate in the proceeds of it should it be successful.
All right, I'm gonna call speed round because I gotta leave in 12 minutes to pick up kids from school.
All right. We got Poria raising 500,000 pre-seed in return, willing to give away 7% of the company. This automatically puts me at the 7 to 8 million pre-money valuation. Isn't that a valuation what you just mentioned not acceptable for a pre-seed level?
So again, you got to take a look at market, and you reference YC in this statement, right? And Y Combinator is a very specific thing, right? Y Combinator is designed to jet out hypergrowth companies into a network of salivating VCs. Right. So if you get through YC, your likelihood of receiving funding at good terms after their investment skyrockets. That is their whole brand. Right. If you're not in YC, you may not be able to command the valuation that a YC company can get. So you may need to sell a little bit more of your company. So again, it all depends on market dynamics, and market dynamics and the data out there is absolutely a range. You should see if you can find data on your industry and your vertical. If you do have extraordinary traction and investors are already banging down your door, maybe you can make this work. Just remember that you are going to have to exceed that valuation cap at the next round. That's the expectation you're setting, and continue to exceed that into the future.
Other little point there, YC takes 7% and they give you $150,000 at the earliest pre-seed stage. You're saying a 500,000, so the size, the amounts, and the ownership changes as
Oh,
well.
yeah, that's right.
They do reserve the right to invest an additional 350. I don't know if it's 70, 375 or three, whatever, but
Yep.
that's
I
for
think
pro
largely
rata.
at the terms of the next round.
Yeah, yeah, yeah. More ownership for them though. All right, I'm trying to be time sensitive or do. I'll throw this one to you while can we do the conversion from an LLC to a C corp? While I queue up some other questions.
In some cases, we have great resources to give you an understanding of what's required in the different paths that we can absolutely share. We're kind of in the pre-product stages of pushing a process through. So we can help you understand the different paths, understand the considerations, hook you up with experts if you need additional tax guidance and things like that. And in some cases, we can help facilitate the conversion.
And I just threw a link in the chat to a blog post that has a lot of details on that and how we can help. Oh, this is a fun one from Veronica. Do you recommend having an anti-dilution clause in the shareholder agreement? No.
Yeah, well, again, it's a vague question, right? But I assume it's it's for founders and early team members. And if that's the case, then no, likely you do not want an anti-dilution protection, nor do you want outsized voting rights for founders. The reason being is that investors are collaborators in your company. They are investing a lot of money into something that is early and risky in exchange for that collaboration, which comes in the form of participation in company governance on the board and in voting matters. So anything you do to change the norms of how they will typically participate at each stage will make it harder for them to justify the investment. So if you have extraordinary traction, this is your fifth startup and you exited all four before, um, and again, you have investors pounding down your door, maybe you can get away with that. But for most people, it's going to present some serious challenges in fundraising.
Yeah, I would say the word anti-dilution is very much like it makes you wince. So if you're looking for, somebody wants to continue to participate in your venture should things go really well, there's usually mechanisms that you can get in place to incentivize that. But do not look for like, I'm completely protected from dilution. Full ratchet anti-dilution on the investor side is something that is basically like frowned upon in the industry because it significantly puts rigidity in the company's future. But if somebody's like, hey, I want to be sure that if we go to the next round, I can put more money in to maintain my ownership, there's things like pro rata side letters and agreements that are very much like, oh, yeah, 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 we can entertain that. Just the words anti-dilution is usually not what you want to focus on. You want to focus on more about aligning incentives and ensuring people have the ability to continue to participate, whether on the founder side or the investor side.
Yeah, very rarely does anybody get more shares for free.
Yeah. All right, let's dig in a little bit more about taking in friends and family investment from people who are not accredited. This is Lynn's question.
This is potentially a whole webinar, but the easy answer is that having people invest into securities, actually make an equity investment, who are not accredited is very, very difficult in the early stages. There is not a great vehicle for this for small friends and family rounds. If you're raising under $200,000, very difficult to do this economically from a legal and compliance and filing standpoint. So friends and family round, unfortunately, typically means rich friends and family. Um, Even that can be tricky. There are some founders who flout this. It can come back and bite you in the butt. And there are a few different ways to pursue it meaningfully, one of which is crowdfunding. But typically, the amount you need to raise to justify the expense of crowdfunding doesn't meaningfully change the equation for friends and family. Crowdfunding works best if you're going to do kind of a community round and you have a bunch of investors who are going to come in. Some of them are your customers and things like that, where you can get a lot of people in to justify the information filing and the percentage you're going to pay.
That was the most concise I've heard of that. Lynn had a follow-up question, but we can handle real quick. She's on Gus launch and she's got some contractors sign the contract agreement. Do they have to sign a follow-on IP agreement or is the contract agreement sufficient? The
Yep,
contract agreement is
contractor agreement.
sufficient.
Yeah.
Yeah.
Yes.
So every agreement in Gus launch that establishes a service provider role, advisor agreement, contract agreement, IP assignment agreement from the founders also contains provisions that protect the company's IP at the various levels that make sense for that kind of relationship. So you don't go out there and get somebody to sign six different agreements out of paranoia. It's usually baked into the right role match. Thomas McNally asks, this is an interesting one with the last 5 minutes here. What's the cost for a solo founder to get through safe note level? I think that means like what would they expect to pay for a safe note?
Well, I guess there's a few different ways to look at this. Um, the first is this on the left-hand side. There are some kind of metrics or barometers for how much you should spend to get through each phase of a company. That is generally like a total amount. And that is based on how much capital people typically raise at those levels. It will change over time, certainly. This one's a little bit out of date. We could probably update it. But that's the first step. Like, okay, market wise, how much do people spend to get through this? Um, if you're talking specifically on how much it costs to paper a safe, the safe itself is templatized. So it's relatively cheap. And if you use the standard YC safe, it even says at the top, this is standardized and hasn't been changed. That's what makes it so cheap and easy to execute. You just set the valuation cap and discount. Again, look to market for those things, and you go on your way. The potentially more expensive part of that is if you decide to advertise your fundraise on Twitter, or if you decide to use an exemption, a securities exemption that allows you to raise from unaccredited investors, then the information filing requirements, the amount of legal paperwork you need to file in different places, can increase substantially. And that's generally where the cost comes in from a legal perspective.
And I will say, just to speak our own book here, if you get set up with Gus Launch, all this stuff is in it. So for as little as $450 a year, you get incorporated all the contracts you need. I think it's 1,250, 1,200, yeah, to get unlimited safes and convertible notes or whatever fundraising pre-seed instruments you need. You don't need to go talk to a lawyer to get the board approvals. That's all baked into there. That stuff should be pretty streamlined and straightforward and will keep you in good standing. So if you do it yourself, you're going to probably want to use a lawyer, or you're going to, if things go well, you're going to have to pay a lawyer a bunch of money to clean it up if you just download stuff off the internet and randomly get it signed. But using a platform like ours really, really streamlines all that and saves a ton, literally thousands and thousands of dollars a year on that early stage stuff. All right, we got 2 minutes left. And what is the last one I'm going to pick? How about we haven't answered one from Veronica. Is the co-founder required to be in the board of directors in a more than one founding team?
No,
That's it. You can
skip
wear all
it.
the hats. I answered it in chat before, but often, the CEO, the treasurer, the secretary, and the board member is all the same person until it makes sense to start to distribute that as the company grows. There is no hard and fast requirements of that. Somebody can be a co-founder of a company and just make sure they have an IP assignment signed so that their contributions are owned by the company, not themselves. But you can get going in together and then distribute that responsibility as it makes sense. All right, I'm going to wrap it so we can say goodbye. We will share this recording for everybody who's been asking. In the next couple of days, we'll send this out. We got some links, some high resolution images of the stuff that we shared that were probably a little too small on this. Um, and check us out. We have more questions than we can answer. This is always the case. We see this all the time, and this is what we're experts at, and this is what we bizarrely love doing. Pete and I have somehow just become obsessed with this. So if you're a startup founder and you want to get help, Mission Control is honestly just the first step. Jump into Mission Control. We have weekly office hours. We literally have one tomorrow. We will put this information at your disposal, at your fingertips on a regular basis so that you can just make more progress on your venture. And then when it makes sense, after a couple sessions and you realize like, wow, I really do need a Delaware C Corp. One, you save a ton of money on it by being in Mission Control. And two, we set you up with the best practices to hopefully increase your odds of success in this wild and crazy world of entrepreneurship. You'll get to see us every week, and we have a ton of fun, and we're starting the companies of the future. Thank you, Pete,
Awesome.
as always.
Thanks, everybody. We'll get the recording out hopefully by tomorrow. Hope to see you again soon. Join us on Thursday for more questions. Join us in Mission Control for more questions and answers every week.
Oh yeah, that's right. We'll include an invite to Thursday's session as well, which will be a more informal Q&A with our friend from Dan over at HubSpot. So if you haven't got the email yet, it should be in the follow-up to this as well. Have a great week. Good luck on your
Thanks,
startups.
everybody.